Hi, everyone. The tariff news is causing significant market turbulence yesterday and today, with major U.S. stock indexes down significantly. Companies that are heavily reliant on Chinese imports, such as Apple, Boeing, and Caterpillar, are feeling the brunt of the impact. So far, international markets are faring much better, and as expected, bond markets are holding up and adding positive performance. While some tariffs were anticipated, the magnitude of these measures and the Trump administration's willingness to escalate them in response to retaliation, an outcome that seems inevitable with China's announcement overnight, have caught investors off guard. There's increasing clarity, though, on how these policies will affect consumers, businesses, and overall inflation. The concern is that the protectionist measures could push the economy into a recession. It's also becoming increasingly evident that the inflationary effect of tariffs lasts much longer than just a quarter or two. Reshoring production will take time and likely result in higher costs for the end consumers, compounded by rising labor costs, especially in the face of ongoing deportations. The only silver lining is that something will have to give. Some of these policies are so aggressive that the administration may have little choice but to walk them back. Unfortunately, the catalyst for such a shift will likely be economic pain. We don't expect this to happen overnight. It will take time to unfold, and volatility will likely remain elevated for a while. However, the Fed is now more inclined to lower rates, which is a positive for fixed income, though much of that is already priced in. We went into this year following a positive fourth quarter, with corporate earnings coming in at 13% growth. That's 5% more than the expected 8%. And our third and final fourth quarter GDP numbers were revised up, this showing economic strength coming into the new year. In the next week, though, attention will shift to Q1 earnings. And that we'll see really the first time that companies are going to be able to show us what their earnings are doing affected with these policy changes. And it's still relatively new because today's and yesterday's announcements on tariffs won't actually be impacted in corporate earnings until the end of this quarter that just started. The labor market's another important area we are watching. And yesterday, jobless claims actually fell. And today, the Bureau of Labor Statistics reported the U.S. economy generated over 100,000 more non-farm jobs last month than was expected. This is showing strength in the labor markets. However, job cuts have jumped, with 80% of those represented by government cuts, and we continue to watch for trickle-down effects. There's much uncertainty, and that is exactly what causes the market volatility. We understand this could be a scary time for some clients, but this is precisely why we manage diversified portfolios with capital preservation as a key objective. Some clients remain skeptical of international markets or question why an equity portfolio doesn't simply mirror the S&P 500. Where a handful of stocks recently made up as much as 37% of that index. Days like today and yesterday highlight the value of a more active approach in managing risk and exposure that's based on fundamentals. There's an old saying that concentration builds wealth and diversification preserves wealth. For our clients taking money from their portfolios, we raised cash in January ahead of this market volatility, and most will not need to sell anything in the portfolio in 2025 to meet their cash flow needs. For accumulators, we would like to remind you that these are the types of market opportunities that should be seized. We are so often short-sighted when it comes to long-term investing. We don't know exactly when the market bottom will be. It could be now, or it could be in 5 months. But stocks have dropped in price and valuations have gone from overvalued to undervalued in just the last 6 weeks. It may take time to see the results of seizing these opportunities, but experience tells us we will likely be happy with the results. As always, our team is here to help you achieve your long-term financial success, and that includes reminding you that investing is a marathon and not a sprint. To focus on what you can control and what's important, like family and health, and to stop watching the news. Think of the old adage that the market takes from the impatient and gives to the patient. And finally, volatility and market corrections are normal parts of investing, and you've been through this before. We hope you have a good weekend, and if you'd like to chat or need anything, please don't hesitate to reach out to the team. We appreciate the opportunity to serve you.